Hi. Stock prices changes every day depending on the market forces. So how to know when does a stock price increase or decrease? All of a sudden we see some company's share value gets really high and the other company's share value goes really down. How to predict when a company's share value, the stock prices will go high or will it go down? How to predict that? And that prediction is based on certain factors. And that is what I'm going to be explaining in this video, Stock Market for Beginners, episode 3. To understand when a stock price will increase or decrease, we first need to understand supply and demand. If many people buys a specific stock, then a demand is created for that stock, and when there is a demand, the price of that stock goes high. If many people sell a specific stock, then there is no demand for that stock. So here the supply will be greater than the demand. And that is when the price would fall for that specific stock. So when demand is greater than supply, the price increases, and when the supply is greater than the demand, then the price falls. Understanding supply and demand is very easy. But what is difficult to understand is that what exactly makes people like a specific stock and dislike another stock. So all of a sudden there is a huge buying or selling of certain stocks, and how to predict when the share value will increase or decrease. This is when you need to pay attention to the news. You need to know which news is positive for a company and which news is negative. To make it more clear, let me explain you 3 factors depending on which you can predict the stock prices to increase or decrease. The first factor is the fundamental factor. This is an in-depth method of researching or studying a company's financials and external factors to measure the value of its shares. And through this, we can determine a stock's real, or you can say fair, market value. In simple words, if my company is not performing well currently, but the share price in the stock exchange is really high, then you can just predict that the prices are going to go down very soon, since the company is actually not doing good in real. So in this case, you will have to sell all the shares immediately in case if you have purchased it already. It is also the reverse way. In case if the share price of my company is lower in the market, but actually if my company has recently launched something new and it is performing well, then you can know that the share value of my company is going to increase very soon. Then what do? You just buy the shares. Let me explain this with a simple example. Say for instance, the share price is really high for a specific company and you wonder what is really happening because the share price keeps increasing. So you wonder what's happening, and then you get to know that the company is actually selling or giving away the $100 worth of products for $50. What does that mean? The company may be doing well currently, but in the long run, no company can survive that way. So you can guess or you can predict that the share value will fall sooner or later. So analyzing the fundamental factor of a company means learning the actual performance of a company, its actual financial growth, actual amount of debt or loans that it has reduced recently, and so on. So that through this fundamental analysis, we can understand the real face of the company. Fundamental factors are a combination of 2 things. The first one is earnings per share, that is we call it as EPS, that is how much does the company actually earn per share. And the second one is price to earning ratio, we call it as P ratio, that is the share price divided by its actual earning per share. Now the second factor is the technical factor. This means using the historical charts to predict the share price changes. Historical prices are a helpful way of predicting future prices. Technical analysis is totally different from fundamental analysis, and here there is no need to pay close attention to measure the company's intrinsic value, but instead use stock charts to identify patterns and trends that suggest what a stock will do in the future. If you can familiarize yourselves with the past growth patterns of the company, you can also recognize the patterns in case if they appear again. Simple example, mangoes will be sold in supermarkets for a higher price in summer than the winter. This happens every year, so we predict it will happen next year too. To give another example, I can say maybe a specific company performed well earlier when it launched a specific product last time. So this time when they launch a similar product, you can guess, you can predict that the company is going to perform well again. History repeats is the belief of technical analysis. Now the third factor is sentimental factor. Understanding market sentiment is the most powerful tool for an investor. Sentimental factor in share market refers to the overall feeling that traders have about an asset. Say for instance, there are newly built houses for sales and there is a mall that is going to be built nearby in future. There is no assurance that the mall will be there forever or that the mall will perform well forever, but most people believe the mall is going to be useful for them in some way and they rush to buy these houses. Hence, a demand is created out of nowhere and the price of those houses goes high. Or say there is a new feature added to a specific app and you're comfortable using it. Then we simply believe that many people are going to start using that app. This is not based on any technical or fundamental analysis but purely psychological. Most investors are usually influenced by the mood in the markets instead of concrete news or figures. It can also be quite subjective and assumptive. So which of these factors do you think is easier for you to practice while investing in shares? Let me know in the comment section. There are many answers or predictions to why people like certain stocks at a specific time. And if you ask any investor, everyone will have their own ideas and strategies. In fact, most people believe that it isn't possible to predict how stocks will change in price, while few others think that by drawing the stock charts and by looking at the past price movements, you can actually determine when to buy and sell. The only thing that we do know as a certainty is that stocks are volatile and can change in price extremely rapidly. So in such situations, understanding these three factors will help you to predict when the stock price will increase or decrease.